Now it's time for the Personal Finance Corner. Faye is right here in the studio. Faye, what's up for discussion today?
Well, we're going to relook at FMPs because given what we saw from the RBI, of course, that entire now interest rate cycle is turning, and we'll find out if FMPs still make sense. And the other reason why we should look at FMPs is that over the last couple of months, mutual fund houses have launched or have put in at least 234 FMPs with SEBI for clearances. Now compare that to 74 that they had filed over the quarter of the financial year. That gives you an indication of how important FMPs are in this market right now. Let's bring in Dhirendra. Dhirendra, should all retail investors now be adding FMPs to their portfolios given the interest rate cycle as well?
Yes, there has been a complete turnaround in the interest rate outlook. Everybody was anticipating a rate cut in the first quarter of this financial year, and FMPs were, in fact, money getting out of FMPs, the maturing FMPs. That money was finding its way into long-term bond funds, income funds, dynamic bond funds. But we see that there is a complete turnaround in thinking. The rate outlook has changed completely, and particularly after 15 July, when we saw this big decline in value of long-term bonds and all bonds in general, investors are finding it way too volatile, the open-end income fund, and anybody who has a defined term in mind is locking his money into FMP. FMP yields have gone up because the interest rates have gone up practically. So there's a strong case. So if you have a predictable time frame, consider FMP. Their appeal has only increased, and it's more attractive today than it was before.
Well, Dhirendra, we know FMPs come in different tenures. There's for 3 months, 6 months, 1 year, sometimes a little longer than that. Is there a benefit then of choosing more than one FMP and using different tenures to bring down our risk? Is that something you would recommend?
Yes, there is a benefit, because FMP at a very basic level is a very simple fund. You invest your money, and all that money finds its way into buying bonds by the portfolio, and it is not an actively managed portfolio. The FMP fund manager just buys those bonds and holds them till its maturity. So if you are putting all your money into one fund, and if that fund is exposed to higher credit risk, and if it faces one, then your diversification will come in very handy.
All right, Dhirendra, with over 234 FMPs to choose from, could you tell us how we should choose an FMP? Or could you name a couple of fund houses right now with good track records?
Very difficult to choose a FMP, because everything is, you don't have a track record of an FMP, but all that you have is the track record of older FMPs. But even that is not very meaningful. That is not meaningful because looking at the return, or looking at the kind of credit exposure that the fund would have taken, will be a function of time when that FMP was launched. So it will not be as useful. But I think funds, here the economies work, so larger funds might be better. That apart, the particular statement by FMP is that what they will not do, even if you are compromising on potential higher return, for sake of superior credit quality, and if that fund company is stating that, go for that. Go for the conservative one and well articulated objective, or the framework of the FMP portfolio which that fund is stating.
All right, let's quickly take in one of our questions from a viewer. Sudeep, who's 25 years old, has written in, Dhirendra. He wants to buy a home in 6 years from now. He has a monthly saving of 25,000 rupees, and he wants to know what sort of a mutual fund allocation strategy he should have right now. He can make about 15% every year from that investment. What would you recommend he does? It's a short time horizon, but he's a young investor. What's your recommendation?
It's very difficult to pin down on a return over the next 6 years, but I'm hopeful that there will be some market turnaround, and there will be reversion to mean, and last 5 years has been extremely difficult for the equity, so very likely, but it is not worth taking a chance. Of course, your goal is little negotiable. It could well be 6 years, it could be 6 to 8 years, because you are unlikely to need that money on a specific date. So I would say consider a very small allocation to equity and rest in fixed income. Being in fixed income in a manner that it is tax efficient will be handy. So consider 60-70% into fixed income, remaining into diversified equity, and that should not help you achieve that 15% return. It might be, but I'm not very sure of that. But that's the only way to approach this goal conservatively.